Hi, and welcome back to our edition of Technically Speaking. My name is Violeta Todorova, and I'm Senior Market Analyst at Legacy FX. European stock markets and US futures sink, crude oil prices surge as US and its allies consider ban on Russian oil imports. US Secretary of State Antony Blinken said on Sunday that the Biden administration was in discussions with European governments about banning imports of Russian crude oil and natural gas. Following the news, crude oil prices gapped up on Monday, reaching $127 intraday high, level not seen since 2008. Oil prices have been rising steadily from a low of $62 in December. 12 days ago, the day before the invasion, crude was trading at $92 and is up almost 40% since then. From December to March, in the short span of 3 months, the price for a barrel of crude oil has risen more than 100%. Looking at the long-term chart, a retest of the July 2008 high of $147 appears increasingly likely. Gold spiked too, advancing to $2,000 an ounce and appears headed to $2,070 as Russia escalates the war in Ukraine. A technical break above key resistance of $2,070 could bring the price to $2,150 over the medium term. New sanctions against Russia triggered massive jump in commodity prices as well. Since the invasion, aluminium is up 23%, wheat up 36%, and palladium up 39%. With everything so uncertain, fears of stagflation also started to creep in, with concerns over high commodity prices impacting inflation and slowing global growth. Further rises in the price of crude in the short term is not out of the question and will put further pressure on global economies, leaving central banks debating how quickly rate hikes should be implemented. European stock markets pounded, with the DAX 40 down more than 4% in early morning. The index has regained ground throughout the day. However, overall momentum conditions remain poor, and any short-term bounces from here are likely to be short-lived. Soaring crude prices triggered concerns of stagflationary shocks that might lead the ECB to maintain its ultra-easy policy. Since January, the index declined from a high of 16,270 points to a low of 12,425 points today, down almost 24%. The euro extended its slide, reaching a low of 1.0805 against the US dollar, and looking at the weekly chart, further weakness to 1.0650 in the coming weeks cannot be ruled out. US equity futures are currently down. Soaring commodity prices have raised fears of even greater inflation, with data due on Thursday expected to show US CPI climb to 7.9% year-on-year in February. Fed Chair Jerome Powell said last week he would support a 25 basis points interest rates increase at the central bank upcoming meeting next week, but added that he would be prepared to move more aggressively later if inflation does not subside as quickly as expected. Historically, US equity markets have been under selling pressure a week before rate hikes. Therefore, a retest of the February lows is possible. Thank you very much for watching. Hope to see you next time.